Before I start trading the forex market, there are certain criteria that I look into before I place a trade. I don't randomly place a trade whenever I'm trading the forex market. I always have a plan, right? So that is what I'm going to be sharing with you in today's video. I'm going to be sharing with you 5 things that I take into consideration before I place a trade. And like I said in my previous video, forex trading is just like a business. If you treat it like a business, you are going to be profitable in this business. But if you treat it like gambling, you are not going to last. You are going to be losing money all the time. So that is why I always advise that you trade your forex trading as what? As a business. Treat it like a business and you are going to enjoy the benefit. So like I said, before I place a trade, there are 5 things that I always take into consideration before I place a trade. So my advice for you guys is to make sure that you watch this video from the beginning to the end. Don't skip any. Make sure you watch this video from the beginning to the end and you are gonna learn a lot from today's video. For those of you that have not subscribed to my channel, please don't fail to subscribe. Endeavor to hit the subscribe button so that whenever I publish new content, you'll be the first to be notified. Make sure you turn on the notification icon so that whenever I publish new content, you'll be the first to be notified whenever I drop new content. So before I give you my 5 tips, right? Because these 5 tips that I'm going to be sharing with you is what every price action trader is using, right? So once you master these 5 tips that I'm going to share with you in today's video, you have automatically mastered price action. So with this strategy, you don't need any indicator. What you need is just price action, naked price action. If you want to trade based on what the market is doing without looking at any indicator or news or anything at all, you just want the pure naked price action of what is happening in the market. So that is what you are going to learn from these 5 tips that I'm going to be sharing with you in today's video. So if you are a newbie that is starting out in the forex market and you want to become profitable, my advice for you guys is to make sure that you pay clear attention so that you understand what this particular video is talking about. Because these 5 tips that I'm about to share with you in today's video, if you are able to implement it, honestly speaking, you are going to become consistent profitable trader. So please, like I said, make sure you watch this video from the beginning to the end. Don't skip any. So the 5 things that I look into whenever I want to start trading the forex market is number 1, market structure. Before I start trading the forex market, I always look at the market structure, right? Have it at the back of your mind that you can trade any pair that you want to trade, right? But make sure that you use small number. The lower the number, the better, because if you decide to trade so many pairs, you're going to get confused and you might not be able to monitor all the pairs, right? So my advice, my candid advice for newbie is to focus on only one pair. As for me, my favorite pair is gold, SAUSD. That is my favorite pair and that is the pair that I've been using for many years and it has been profitable to me, right? So I trade gold. So it is now left for you to pick the pair that you prefer, right? It can be Euro USD, GBP USD, but make sure you pick just one single pair and focus on it if you're a newbie. So once you have picked a single pair that you want to focus on, the first thing you should take into consideration before placing a trade is to look at the market structure. So looking at the market structure entails what the market is currently doing, right? So you want to know whether if the market is in an uptrend, downtrend, or ranging. So if the market is in an uptrend, the market will be making higher high and higher low. So that is the confirmation that the market is in an uptrend. But if the market is in a downtrend, the market will be making lower high and lower low. So that confirms that the market is in a downtrend. But if the market is ranging, right? The market will be making series of highs and low, right, at the same level. So the market will have a level where it comes down. When the market goes to, it comes down, right? So that is when we see the market is ranging. So what you do is, when the market is trending up, you only buy, right? You buy through the lows, right? Because when the market goes up, it tends to make a retracement before the up move continue. So at that point where the market makes a retracement, that is the point where you are supposed to place a buy trade, right? So you buy from the low when the market is in an uptrend, and you sell from the high when the market is in a downtrend, right? So when the market is in an uptrend, the lows becomes what? A support level. And when the market is in a downtrend, the highs becomes what? A resistance level. Don't ever make the mistake of selling during an uptrend or buying during a downtrend. You only buy and sell when the market is ranging, because during a ranging market, both the buyers and the sellers are in equilibrium. The sellers sell from the top while the buyers buy from the bottom. So when the market gets to the resistance level, the sellers will step in and push it down, and when the market comes down to a support level, the buyers will step in and push it up. That is when the market is ranging, right? So in the ranging market, both the buyers and the sellers are exchanging price. So that is when you can buy and sell. But if the market is in an uptrend, it means the buyers are in charge. You are only meant to buy, do not sell. And if the market is in a downtrend, it means the sellers are in charge. You are only meant to sell. You do not need to buy. So the first thing is to understand market structure. Very, very important, right? So once you have looked at the chart, right, depending on the time frame that you want to use, right? Because in the forex market, we have different types of traders, and the type of traders determine the time frame that you want to use. So position traders use daily time frame. Position traders are traders that hold trade for months, so they use daily time frame. While swing traders use 4-hour time frame. So swing traders are traders that hold trade within days or weeks. So swing traders use 4-hour time frame. Why day traders are traders that hold trade within a day. So I think the best time frame for day traders is the 15-minute time frame, right? But as a day trader, my advice for you is to always use the 1-hour time frame to identify area of value, right? Use the 1-hour time frame to identify the directional movement of the market. Then you can now scale down to the 15-minute time frame for your entry. So as a day trader, my advice is to make use of both the 1-hour time frame and the 15-minute time frame. Use the 15-minute time frame for entry and use the 1-hour time frame for identifying market structure and area of value. So after looking at the market structure, which is the first step, the second step is to look at what? An area of value. An area of value has to do with support and resistance. So support and resistance is the foundation of all technical analysis. So there is no forex trader that will tell you that he or she does not understand the importance of support and resistance level in forex trading. So after looking at the market structure, the next thing you're going to look into is an area of value, which has to do with support and resistance level. In other words, you can call it key levels, right? So after looking at the market structure, you look at the support and resistance level, right? So you kindly use what? A horizontal line from your tools and draw the levels, right? So how do you identify an area of value? Now let me explain. If the market is in an uptrend, right? If the market is going up, then gets to a point and reverse and start heading down. That point where the market gets to and reverse becomes what? A resistance level. And if the market is going down and gets to a point and reverse and start heading up, that point where the market reverse from becomes what? A support level. So what you need to do is to watch the market come back to that point and get rejected. So if you see something like that, you simply use your horizontal line to map that area, right? Because that is what we call demand and supply zone. That is what we call demand and supply zone. So once you mark that area, right, and you watch to see what will happen next, if the price eventually comes back to that area and gets rejected, that automatically makes that area a resistance or support level. That makes it an area of value, right? So there is likely that if the market comes back again the third time, it's going to get rejected again. So that is what makes it what? A support or resistance level. So a strong support or resistance level is when the market could not break a level 3 times. That makes that level a strong support or resistance level. So you watch and see whether if the market is able to break that level. So if the market is not able to break that level 3 times, that is a strong support and resistance level, right? So that's what I mean by an area of value. So once you have identified the market structure, you now look at the area of value, right? So like I said, in an uptrend, if the price breaks above a resistance level, that resistance level could automatically become a support level, because once a price in an uptrend breaks above a resistance level, that price tends to come back to test that resistance level, which has automatically become a support level before the uptrend continues. And if the market is in a downtrend and the price breaks below a support level, that price could come back to retest that support level, which has automatically become a resistance level before the downtrend continues. That is when there is a trend in the market. But when the market is purely ranging, the market tends to receive support and resistance. That is to say, if the market goes to a resistance level, it gets rejected, and when the market comes to a support level, it gets rejected. So that is why once you have identified an area of value, you use your horizontal line to mark it so that you can be able to monitor it clearly, right? So the number 2 things I look at is an area of value, which I said it is either support or resistance level. So after looking at an area of value, the third thing that I do is to look at what my entry trigger. So that will determine when I'm expected to place a trade. So what is an entry trigger? An entry trigger is a candlestick pattern, a candlestick rejection pattern. That is what I mean by entry trigger. So I need a confirmation, right? I need a confluence to tell me that this is the right time to place either a buy or a sell trade. That is why I will be looking at what? A candlestick pattern. So that candlestick pattern forms my entry trigger. So like I told you in my previous video, there are just 2 most important candlestick patterns that I normally use. One is the hammer, 2 is the shooting star, and the next one is the bullish engulfing pattern and the bearish engulfing pattern. So if the market is in an uptrend, I normally use the hammer and the bullish engulfing pattern, and if the market is in a downtrend, I normally use the shooting star and the bearish engulfing pattern. So these are the 2 major candlestick patterns that I use whenever I'm trading the market. So let's assume that the market is in an uptrend, right? And I was able to discover what? An area of value, which in this case a support level, right? So when the price now comes down to a support level, breaks a little bit below it, and ends up in a wick, that automatically forms a hammer. So once I see that hammer, that tells me that the uptrend is still in progress. So that hammer now becomes my confluence. I will kindly wait for that hammer to close, then I will now place my buy trade, and my stop loss will be 20 pips below the support level. Do you understand what I'm talking about? Or if the market is in a downtrend, right? If the market is in a downtrend, I will simply do what? Look what? At a resistance level. If the price now makes a retracement to the resistance level and breaks a little above the resistance level, only to end up in a wick, so that candlestick automatically becomes a shooting star. So that is what I'm looking for. Once the candlestick forms a shooting star, I will wait for that candlestick to close. And when the candlestick closes, I will immediately place a sell trade, and my stop loss will be above the what? The resistance level. So this now forms my entry trigger. So now after I have, after I have done my entry, the next thing I will look into is exit when I am wrong. After my entry trigger, the next thing is exit when I'm wrong. So what is an exit when you are wrong? An exit when you are wrong is your stop loss. You know fully well that your stop loss will help you to prevent you from series of losses, from unnecessary losses. That is the help of a stop loss. So stop loss will help you to know, to protect you when your setup has been invalidated. So my exit when I am wrong is my stop loss. So where will be my stop loss? My stop loss will be at a level when it is triggered, it automatically tells me that my setup has been invalidated. So my stop loss will be above the resistance level if the market is in a downtrend, or below a support level if the market is in an uptrend. So that if the price eventually breaks above the resistance level and continue heading up and smash my stop loss, I will automatically know that the trend have changed direction and my loss will be minimum, right? So my loss will be small. Or if the market is in an uptrend, right? The market is in an uptrend, then reverse back and then break below the support level and hit my stop loss, I will automatically know that the setup has been invalidated, which means that the trend have changed from an uptrend to a downtrend. So my loss is going to be minimum or minimal. So I'm going to lose little, right? So that is the importance of stop loss. So that is why I always consider that very important, because stop loss will help you to protect your capital in case if the market goes against you. The stop loss will protect your capital. It will make you to lose little, right? Because if you place a trade without a stop loss, you might end up blowing that account in a single minute. So that is why using a stop loss is very, very important whenever you are trading the forex market. So that is what exit when you are wrong. So the fifth thing that I consider again is exit when you are right. So what is exit when you are right? Exit when you are right has to do with your take profit, right? So the question is, where will be your take profit, right? So it depends on the type of trader you are, right? Are you a trader that has a target take profit, or are you a trader that is riding a trend? So this is what you should look or take into consideration. If you are a trader that has a target take profit, then your take profit should be at what? A resistance level if the market is in an uptrend, because you know that is where the price tends to make a retracement. When the price gets to a resistance level, it tends to reverse from there, right? So if you truly want to have a target profit, you should place your take profit at an area of value which is either a support or resistance level. So if the market is in a down move, you should place your take profit at what? At a support level. If the market is in an up move, you should place your take profit at a resistance level, because that is the level when the price gets to, it tends to reverse. But if you want to ride a trend, then you should use the moving average. So you are expected to plot either a single moving average or a double moving average, and you wait for a crossover. So if price breaks below the moving average and close, you know that the trend have changed direction, right? The trend was formerly in an uptrend, and now for the fact that the price has closed below the moving average, it means the trend have changed from an uptrend to a downtrend. So you close your trade once the candlestick that crossed below the moving average closes. You now close your trade, right? So this is how you are able to secure your profit, because if you leave it, the price might reverse and you may be able to lose all your profit. So when we talk about exit when you are right, it has to do with take profit, right? So there are different ways you can place a take profit. It can be a target take profit, or you wait for a moving average crossover, because if the market is in a strong up move, right, you're going to ride so many trend, or you're going to make so many pips before the market eventually crosses above or below the moving average, right? So you only close your trade when you see a crossover, because sometimes you might not be able to see a crossover for 2 days. If the market is in a strong up move, you might not be able to see a crossover, and in that process you are riding a trend. So in that process you are a trend follower, you are riding a trend, because you make more money than someone who has a fixed take profit. Let's assume that Mr. John and Mr. Mike place the same buy trade at the same level, right? And Mr. John now has a take profit of, let's say, 70 pips. That is 1 to 2 risk reward. Why let's say Mr. John has a take profit of 70 pips, right? Or let's say 80 pips, while his stop loss is 40 pips. That is 1 to 2 risk reward. Why Mr. Mike doesn't have a fixed take profit, why his stop loss is 40 pips, right? So the price can get to 80 pips and triggers Mr. John take profit, why Mr. Mike is still in the trade, right? So for the fact that Mr. John price has been hit, he's now out of the market with a profit of 1 to 2 risk reward, why Mr. John is still in the market, right? So if the price now moves 200 pips, that is the benefit of Mr. John, for holding onto the trade. And if the price moves 500 pips before the crossover, that is the benefit of Mr. John. So Mr. John is only waiting for the price to cross below the moving average before he can close his trade. So the more the price is going up, the more Mr. John is making more profit. So that is the difference between a fixed take profit and those who wish to ride a trend. So these are the 5 things that are always considered before I place a trade. So this is pure price action. You can clearly see that with this type of strategy, you don't need an indicator unless you want to ride a trend. Then you can make use of the moving average, which will help you to be able to ride a trend. So this is the 5 things that I take into consideration before I place a trade. So I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to my channel for more educative content like this, and also don't forget to turn on the notification icon to be the first to be notified whenever I publish new content. And like I said, for the fact that I'm very busy, I might not be uploading videos every day. So I think from now henceforth, I'm going to be uploading videos once in a week. That might be every Saturday or every Sunday. So bear that in mind, right? So thank you so much for taking out time to watch my video. And I say, may God bless you all. Enjoy the rest of your day. Peace out.